Welcome to the InterMarket Analysis Update. This is a weekly video where I look at a number of different things outside of the S&P 500 to see if we're getting any insight as to what's happening inside of the S&P. And this is being prepared for Monday, November 17th. Before I get into the video, if you're new to these videos, I do have a thing called the SPX Investing Program. It's a separate website. It's run through Substack, and I have a number of different things there that you don't find on YouTube or Rumble. And until the end of 2025, it is free. So feel free to check that out. There's a link right up here in this graphic. There's also a link right below this video that will take you to that website. Check it out and see if you find it helpful. All right, the different areas that are covered in this video. Now, as it applies to the S&P itself, we do go through valuation. We look at historically and then forward looking. And yeah, we've been overvalued. And whenever the market starts taking a bit of a hit and going down, valuation. Yeah, that's kind of when nobody really knows what to think of the downward move, where we're seeing evidence of it, and you'll see it throughout this video and the other videos that I do. It's like they blame the market being overvalued. But we've been overvalued for years, but I'll go through and show you those charts. Then we go through a pretty extensive look at growth versus value. Now, the takeaway from this has been, in the bigger picture, growth is outperforming value. That's positive for the market. In the shorter term, we're seeing value outperforming growth, and that could suggest that if we're not done by testing the 50-day moving averages across a number of different indexes, then maybe we still have a little bit more to go to the downside because the market has been shifting over and looking more defensive. When growth starts to outperform value, then that's when we're starting to improve and the market is more positive. Then we go through inflation, which doesn't seem to really be a concern right now. Plus, we haven't really been getting any reports. We had CPI, which seems like ages ago now, and that seemed okay. Now that the government is back in operation, we don't know when the reports are going to come out and what reports are actually going to be released. So we look at what does the market think of inflation, and we look at a lot of different markets just to keep an eye on them, see if anything crazy is really happening. And then I go through the 11 S&P 500 sectors. We look at them individually. Then we compare them to the S&P itself. Now, one sector that's really been coming on strong lately is the defensive sector. It's healthcare, because you have to have healthcare no matter what's going on in the economy. And that's been performing quite well after just getting hammered. Well, the earnings are coming in pretty good, and a lot of folks are starting to buy that. Okay, that could be a play in and of itself. But since it's a defensive sector and it's coming on strong, does that mean we're going to see a general shift in the market? Now, based on what we see now, we're just following this to see how things end up developing from here. And then we'll look and see, okay, even though it's been improving a lot and it's been up pretty strong, how's it doing compared to the S&P 500? Then I look at a number of different indexes. I actually have one new chart to show you that I've been talking about, but now I finally put it in the video, and that'll come up later on. Then we look at different correlations between different markets. No market exists in a vacuum. We'll see how these are interacting with each other. Then some very long-term trends, and that mainly involves looking at monthly charts. And then we have a positive and a negative list right at the end. There's one change. Bitcoin is now in a downtrend. It's under 100,000. There's been some money coming out of Bitcoin lately. It's really been dropping. And the other chart that's new that I'll show you is what's the correlation like between Bitcoin and the NASDAQ 100. And we'll go through that chart here in just a moment. All right, so first of all, let's look at valuation. Yes, we're overvalued. We've been overvalued. We're way up high here when we measure the distance from the PE ratio of 20, which is the red dashed line, and the S&P, even with a bit of a downward move. Now, this is a monthly chart. So far for the month, even though we're supposed to be in a time of positive seasonality, we're down 1.55% for the month of November so far. But hey, we're just getting about halfway through it now. But we're way far away from this line, and that's overvalued. Now, this is looking historically. These are earnings reports that have already come out. And then just to show you, this also is the same thing, just going all the way back to 1980. And you can see we spend a lot of time above the red dashed line. But when we start going down, valuation. Okay, and then Shiller he came out, Robert Shiller came out with a variation of the PE ratio where it smooths it out using earnings over a 10-year period of time, called the Shiller PE ratio or the PE 10 or CAPE, CAPE. You might see it by those different names. And we probably should use some more dynamic measurements on here because we've been very, very overvalued with this for a long time. We're coming in at 39.72. And for a long time now, the median and the mean has been between 16 and 17, which, yeah, okay, we're quite overvalued there, more than double what we are on an average basis. And so we're not quite back to where we were back in the year 2000. And believe me, if we get up here, folks are going to be screaming like you wouldn't believe. But we still have a ways to go before we even get to that level. That would be just under 45. Okay, now the market uses forward PE ratios, coming down a little bit, but still really, really high. When we look at the mega caps, coming in under 30 now at 29.5. Again, we're above that 20 level. And coming down here, we're at 22.1 with the S&P, still above 20. And then we have the S&P 600 and the S&P 400. These are the small caps. They're more fairly priced. And they're not performing all that well now. We see little bits and pieces for, a day here. The small caps seem to break out and then they just kind of do nothing for a while or they start going down. They really wanted a rate cut in December and it's looking more and more doubtful that that's actually going to happen. And so that's been pushing on the small caps because they have to borrow a lot of money to grow and just to operate. And if they're paying more in interest, that means it's not going to profits. And so their stocks don't do well. Small caps do better in a lower interest rate environment. Okay, then we look at growth versus value. Now, first of all, this is growth by itself. Seeing a little bit of weakness here underneath the 50-day moving average. Still in an uptrend, though. Still above the 200-day moving average. So it's still positive. But yeah, it's coming down a little bit here and taking a bit of a hit. And we look at value, which is still above its 50-day moving average. And it's coming down too, taking a bit of a hit, but it's been holding up a lot better lately. Where we get the insight is when we look at ratios between the two. Now, growth in the bigger picture is outperforming value, but it has been pulling back. And when I keep talking about the market's getting more defensive, this is what I'm talking about here. We ticked up a little bit on Friday, but in the bigger picture, we're doing fine. Shorter term, we're a little bit concerned about this now that we're falling further below the 50-day moving average. Then on the bottom, I have an inverted version of this same chart where we're above the 50-period moving average. Then we look at a number of different growth to value ratios. This first one is ETFs. And we just see where growth is outperforming value, but falling under the 50-day moving average. And this is value underperforming growth, but above the 50-day moving average. And then a growth index versus a value index, seeing a little bit of pullback recently here, but bigger picture positive. This is that same index, but showing how value is underperforming growth, but now I'm coming up above the 50-day moving average. And then I show this in the daily video. This growth to value ratio has actually been holding up a little bit better, but even it's coming down into the top end of the rainbow. Value to growth coming up into the underside of this rainbow. And small caps, which were looking really good with their growth to value ratio, even though the index didn't really follow through with anything all that significant. And now that's starting to pull back, even though it's still looking positive in the bigger picture. Then we have mid cap growth to value. This had been holding up better too, above its 50-day moving average. And then we're getting more confirmation that maybe that rate cut won't happen. And boom, this is dropped all the way down below its 200-day moving average. This is the one that I pay attention to the most. This is S&P growth to value, where, again, we topped out at the first part of August. Then we came down below the 50-period moving average. We could not get above this, and now we're starting to drop down. So I've been talking about this more defensive nature going back to the early part of August, but it just hasn't really had any follow-through based on price that's consistent. We have a down day here, a down day there, and then we seem to bounce up out of that. And we tested the 50-day moving average for the S&P and a number of different indexes this past week. And so far that level is holding. Is that enough? Are we going to come up out of that now? And is this ratio going to start to go back up? Well, if we do try to bounce up out of that and this ratio continues to go down, that's a warning sign to us. Inflation doesn't seem to be a problem. This is the only outlier right now, a monthly chart of inflation versus deflation. And it really spiked up, but now it's coming down. And we look at a monthly chart of the CRB index, which are commodities. This is still above an advancing moving average, but not really busting out to the upside. And here is a daily chart of the CRB index. It's going sideways as well, not really inflationary there. Now we are in an uptrend when we look at the Baltic Dry Index, and this has been in an uptrend for a while, and this is a proxy to see how much does it cost to ship products from point A to point B, specifically in the Baltics. And when it's going up, generally that means things are more expensive. When it's in a downtrend, that means that prices are typically coming down. So this is still in an uptrend. And then we look at inflation expectations. This is what does the market think? Not all that much. We came up a little bit in the latest reading, but we're not really breaking out of this range that we've been in. Then we look at inflation expectation to tips, and this is coming back up a little bit, but still has been a range bound here. If you go back to 2024 and put most of 2025, this is not suggesting that there's a real problem with inflation either. And then other markets, aluminum here, we just look at this being in an uptrend right now. And corn has been bouncing up, even though it's still in a downtrend. And wheat is still in a downtrend as well. Fertilizer kind of stabilizing. It was going up there for a while. Now it's been pulling back lately. And then lumber's in a downtrend, but it bounced back up to its 50-day moving average, but not really showing any inflationary pressure here. Oil, and again, this could be inflationary or deflationary, but also geopolitical. And OPEC came out this past week and said, yeah, the numbers that for 2026, the supply and demand numbers we think are going to be about even. And that put a little bit of a hit on oil earlier in the week. And so it's in a downtrend right now in the high 59s. We look at the correlation between oil, the red dashed line, and the 10-year yield, the black line, neutral right now. So not really giving us any insight there. And then the gold to oil ratio, well, gold has been going up. Oil kind of not really doing all that much. But when this ratio is going up like it has been over the last couple of years, that means gold is outperforming oil. And then gas, which is in a downtrend, although it bounced back above its 50-day moving average. Heating oil starting to see an uptrend here. Now, we are getting into the colder months, so you might think that, okay, heating oil might go up a little bit there. Natural gas, which is still in a downtrend, but it's really breaking out above both of its moving averages. And then diesel starting to go back up too. Now, we are seeing some rising here, but it's not really like skyrocketing or going parabolic or anything like that. So we'll just keep an eye on this. That's why we look at this every week just to see longer term adjustments here, but on a regular basis. Okay, copper, which is in an uptrend, that bodes well for the economy. Copper to gold ratios continuing to go down as copper's been underperforming gold. And a longer term look here, the black line, that's the copper to gold ratio. And we also have the 10-year and 2-year yields plotted here, where everything has pretty much been coming down overall. And then gold, it hit that all-time high back in October. And then there was some profit taking, trying to make another run at it, but then in Friday's session ended up coming back down. And then silver, a similar thing here, got close to its previous all-time high, but seeing some profit taking recently, but still in an uptrend. And then we look at a gold to silver ratio here. And when this is going down, that means gold is underperforming. Now, over the last couple of sessions, gold's been outperforming, but we've been seeing silver coming on a little bit more strong than gold. And then we plot the US dollar index down here, and this is pretty much neutral. We're not really getting any insight between the top chart, the ratio, and the dollar itself. They, when we pay attention to this, are they highly correlated? We would get a high reading, meaning they're going in the same direction at the same time. And if we get a very low reading, that means we're going in opposite directions at the same time. Okay, now what's really interesting here is we're generating a golden cross on the weekly chart for the US dollar index, but we still have a ways to go here on the daily chart, which is just the opposite of what you would think. You would think daily charts would react quicker. It doesn't seem to always work that way with the dollar. And the lines were a lot closer to each other on the weekly chart where they're further apart here between the moving averages. But we're still below that 100 level. Now, we're keeping an eye on this because if we do continue to go up, that could put some pressure on stocks. Stocks like a weaker dollar, if the dollar really starts to go up, that could put a little fear into the stock market. And then we compare the euro to the dollar. This is almost a mirror image of each other. And then we also plot on this chart with the Japanese yen. And then I break these out where we have the euro, it's underneath its 50-day moving average, but now it's starting to come back up to its 50-day moving average. And the Japanese yen, which is in a downtrend, and the dollar is still in a downtrend on the daily side. So that means the Japanese yen is even weaker because it's in a downtrend compared to the dollar, which is also in a downtrend. So this is helping the dollar to show some improvement. And then we're coming back up to the 200-day moving average with the British pound after falling underneath the 200-day moving average. And we look at some index ratios, not really seeing anything all that crazy right now. This is the weighted versus equal weighted version of the S&P. They're more or less going hand in hand with each other. When we were coming down in October, we were seeing the equal weight actually going down quicker than we were the weighted version, but now they're pretty much paired up with each other. And another way of looking at this ratio, when this is going down, that means the equal weight is underperforming. And actually, over the last couple of trading days, the equal weight is outperformed. And that's why we're seeing a bounce up in this ratio as money's been going to the rest of the S&P, not just the big names that really drive the index. And we look at a stock to commodity ratio, and even though stocks have been a bit under pressure, we were virtually flat this week on a weekly basis. And we're seeing some technical damage right now over on the daily side. But even with all that happening, we're still above the 50-day moving average with the stock to commodity ratio. This is the commodity to stock ratio, still a little bit under the 50-day moving average. And this is where we're seeing a little bit more of a defensive tilt. Now you have the NASDAQ 100, which is growth, the big guys, NVIDIA, Google, Apple, Microsoft. All those stocks are in there, and those are the honeys that everybody likes. Well, you see how they're pulling back recently when compared to the S&P? And now the S&P is a balance between growth and value. So when we see this coming down, that means the market's getting more defensive. But in the bigger scheme of things, growth, the Nasdaq 100 is still way outperforming value, but we're seeing more of a shorter term pullback here. What we're trying to figure out now is now that we're back down to the 50-day moving average, is that enough? Are we going to be able to bounce up off of that? We see a lot of 50-day moving averages coming into play. The ones that we were watching on Friday held up. Now we'll see if they continue to hold up in the upcoming week. And then the S&P 100, a little bit under the 50-day moving average compared to the S&P 500, but bigger stocks are outperforming longer term. That's why I'm saying the bigger picture is still looking okay. It's just we're seeing a bit of vulnerability in the shorter term. The Nasdaq coming back down to its 50-day moving average when compared to the S&P, and they're both doing okay. They're just seeing some weakness recently. And then the Nasdaq 100 is actually starting to outperform a little bit here. But in the bigger picture, the Nasdaq 100 has been underperforming the Nasdaq. And small caps, because we're not getting any more, at least definitely getting any more rate cuts. We might. The Fed might surprise everybody and give it a Christmas gift and cut rates. It's not that it won't happen. It's just a week and a half ago, before the Fed had their last meeting, it was considered a done deal by the markets. And now it's more like, okay, let's flip a coin to see if that's what's going to happen. And so in the meantime, the small caps continue to underperform the S&P. This red line here, that's the ratio that we just saw. And then we can see the blue line, that's the S&P, which has been going up as this ratio has been going down. And mega caps, this is where the really big stocks are at, pulling back here, but not even back down to its 50-day moving average and still in a very solid uptrend. And then we look at a ratio, the mega caps to equal weight, seeing a little bit of a pullback here, not quite back down to its 50-day moving average, at least yet. Dow Jones Composite Average. Now, the Dow set an all-time high earlier in the week. The transports, they had a good day there for a while. And the utilities, they're off of their highs, but they've been holding up fairly well. But we're still seeing a little bit of a pullback here. But in the bigger picture, this index is still in an uptrend. And then the small caps continue to underperform the tech sector. And they've been doing that for quite some time. And we look at the semis to tech ratio. Now, in the bigger picture, semis are outperforming the tech sector, but we have been pulling back lately. Low volatility stocks just kind of going along sideways here, and they've been holding up, and folks have been favoring these a little bit more now. This is what they get into when they're They think the market's going to be under some pressure. But when we compare it to the S&P on a ratio basis, the low volatility ETF is still really underperforming, but bouncing back up more in the short term. And then all world, when you take out US stocks, looking pretty good, setting recent all-time highs here. That's been the story now for quite some time. Then you put the US stocks back into the ratio, pretty much going sideways currently and getting really near a death cross with this ratio. Then growth stocks versus bonds, still growth, even though it's coming back down to the moving average here, the growth stocks are still outperforming. Energy sector, it's been doing good the last few sessions here, coming back up, crossing above its 50-day moving average, but in the bigger picture continues to underperform tech. And the tech sector versus the 10-year yield coming down to the 50-day moving average. So far, it's holding above that. And then the 10-year to the tech sector coming up to the 50-day moving average, and that's acting as overhead resistance. Discretionary to staples actually breaking a little bit below the 50-day moving average. And we've been a little disappointed with this. I watched this and go over it in every daily video. And this is a longer term look at this sector just all by itself. And so, yeah, we're seeing some weakness here, but it's still in an uptrend longer term. Staples underperforming discretionary, but starting to go above its 50-day moving average. And then gold to the S&P starting to go back up here as gold has been outperforming. And gold has been outperforming the US dollar for the most part. And then we look at an advanced decline line study here, and we're holding up better with the S&P right now. You notice even though we declined, we're above the moving average. But with the NYC common stock, mid caps, and small caps, we're below the moving average. So seeing a little bit more weakness there. And traditional Dow theory just coming off of an all-time high and then dropping down with the Dow. The transports were doing a little bit better, but now they're falling back. And then utilities are off of their all-time highs. And we look at a ratio between the Dow and the transports, and transports had one or two good days there, and so we saw this ratio really fall. But longer term, the Dow has been outperforming the transports. And then the transports themselves, see how they came right up here to this resistance, this previous high, and they've been going down since then. And robotics and AI, that's where everything's at right now, seeing a bit of a pullback here into the rainbow with this ETF. And it's been underperforming the tech sector. Now, this particular ETF hasn't performed all that well. It hasn't outperformed the tech sector. You would have been better off just getting into the tech sector instead of getting into this ETF, even though the ETF itself has been doing okay. There's a better ETF that I'll show here coming up in just a second. And then for some reason, this is in the wrong spot. This is the S&P to transports, still showing longer term how it's underperforming. The correlation just coming out of being neutral. And then instead of using traditional Dow theory, we look at using the equal weight version of the S&P, which is not back to all-time highs, and the equal weight version of the QQQs coming off of recent highs here. And then we look at the S&P, the weighted version here, still holding up okay, but off of its highs, as is the NASDAQ. Then the FANG index. This is interesting. We've opened below the 50-day moving average on Friday. These are the really big stocks. Facebook, Apple, Amazon, Netflix, Google, Nvidia. We closed right at the 50-day moving average on Friday. So that support is holding. Is that enough? Now, it was enough before we came down to the 50, bounced off of it, bounced off of it, got near it, bounced off of it. Now, if we start to break below the 50-day moving average, that's going to turn things more negative. So that's why we're really keying on this. And we're not just watching this for the FANG index. We're watching it for the NASDAQ 100, the S&P, the FANG index, and there's a couple other ones that I'll go through later on. We're seeing a real convergence there. This is one of them. We held at the 50-day moving average with the total U.S. stock ETF. Closed just above it, even though we opened below it in Friday's session. Then ARC, it's having a little bit of trouble now. It's underneath its 50-day moving average, but still in a longer-term uptrend. NYC Composite holding up above its 50-day moving average. High leverage loans, another barometer of the economy, still looking pretty solid there. All stocks, U.S. and international, seeing a pullback here, but still above its 50-day moving average. Emerging markets, this is still looking pretty solid here. And the Japanese Nikkei still just coming off of recent all-time highs, almost parabolic here. And here's the change. Bitcoin is now turning into a downtrend when compared to the US dollar. It dropped under 100,000. And at the time I took this chart, we were getting into the 95 range. This is the new chart. This is looking at the correlation between Bitcoin and the NASDAQ 100. And there's a pretty high correlation. Now, this is based on 10 periods. That's pretty short term. And you can see here, just the red line, that's Bitcoin. The bar chart, that's the NASDAQ 100. And they tend to move pretty much in tandem with each other. Now, we're seeing a little bit more drawdown with Bitcoin right now than we are with the NASDAQ 100. Are they going to start to catch up with each other? Or is that going to give Bitcoin a chance to bounce up from these lower levels? Then semiconductors holding at the 50-day moving average and then closed up off of that in Friday's session. Another 50-period moving average we're watching. And then the SMH semiconductor index also holding above its 50-day moving average. And then we look at a rainbow where, yeah, we're coming down here, but so far we're holding above longer term support. And the Dow Jones Semiconductor Index opened below the 50-day moving average, closed above it. This is holding for right now. We came right down to the 50-day moving average before, and we bounced up from that. We're testing it again. Is that going to be enough? Are we going to be able to go up from here, or are we going to start to fall down below this? And here's that same semi to tech ratio that I showed earlier, in case you missed it. Longer term, the semis are still outperforming the tech sector. We're still okay here with the semiconductor to Dow ratio. Coming down a little bit, but still above the blue line. This is the other ETF that's actually held up better. It's an AI and tech ETF, symbol AIQ, and we're holding out at the 50-day moving average. And this is actually more in an uptrend, where that other ETF that has AI in it, that hasn't been doing quite as good. And then we look at the home builders. On top is the S&P, in the middle are the home builders. Fairly strong correlation between the two. We're not seeing them getting all that out of line currently. The micro caps falling down underneath their 50-day moving average. These are the smaller stocks. And then we look internationally. This is longer term using the KST oscillator. Pretty much flat, trying to turn up in China. We are in a downtrend with the emerging markets, flat in Europe, rolling over, trying to turn up in Japan, and starting to see more weakness here with the S&P 500. And then we look at a longer term ratio. This is a monthly chart of US stocks to world stocks. And even though in 2025, US stocks have underperformed, we're still above this longer term moving average. And we're rolling over a little bit here with the longer term oscillator, the percentage price oscillator, or PPO. All right, then we look at bonds here. Underneath the 50-day moving average with the 10-year based on price. But the total bond ETF still hanging out just a little bit above its 50-day moving average. A monthly chart rolling over a little bit, but this won't be complete now until the end of November. Longer term stocks are outperforming bonds. This is a daily chart. We're coming back up to the moving average, but this also shows how bonds are underperforming stocks longer term. And the Pring World Bond Index, really choppy here in an uptrend, but coming back down close to its 200-day moving average. And then investment grade bonds, more high quality bonds here, actually falling a little bit below its 50-day moving average. The Dow Jones Corporate Bond Index also a little bit below its 50-day moving average. Seeing some weakness there. This is just to show the higher range that we've been setting with the 10-year yield after we were seeing 40 years of declining highs and declining lows as interest rates kept going down, down, down. Now they're trying to establish a higher range, which is really more the norm. What we've seen over the last 40 years is the exception. And then junk bonds here. This is the HYG. We're still hanging out around the 50-day moving average. This is JNK ETF, still a little bit above its 50-day moving average. And we've been kind of seeing a bit of a shift here. When we look at junk bonds to government bonds, we're rolling over a little bit, and we're in danger of seeing a death cross here with this ratio. We've been watching this, and if we go back up, then that means junk bonds are outperforming, which has been more positive. The junk bonds tend to follow more what the stock market does. Now, if we start to see some more weakness here, we'll just keep an eye on that, and that could be a warning sign. Then riskier to more conservative bonds, just kind of going along sideways in a tangled rainbow. And then here's a daily chart of the maturities, which again, it seems strange that we were going down for the most part with yields, and then the Fed comes in and cuts rates, and now we're going back up. weekly chart. And we're coming off of recent all-time highs in Japan. I've been watching this red line, which is the 10-year bond in Japan, because back in 2024, when it got above this 1% level, it's like everybody freaked out. And now we're up to 1.7%, and it's like, okay, no big deal. So it all depends on the context of what's happening. And we're a little bit out of the neutral area when we look at the stock to bond correlation. They're having a slight tendency to go in the same direction at the same time. And we look at the volatility of bonds on top, that's the move index, and the volatility of stocks, that's the VIX. And the correlation between the two currently is neutral. And then we look at some stock to bond ratios. Taking a little bit of a hit here, but still in the high end of the rainbow, and you're going to see a lot of that with the upcoming charts. When we look at the S&P to short-term bonds based to 1 to 3 years, this is an inverted version here of 3 to 7 year bonds. Even though they're coming back up here in the longer term, these bonds are underperforming the S&P. The S&P 1500 coming back down in a little bit to the rainbow when compared to short-term bonds. Another broad market measure, the SCHB, that's Charles Schwab broad market ETF, coming back into the rainbow, but still in a longer term uptrend with this ratio. The tech sector coming back a little bit into the rainbow when compared to 3 to 7 year bonds. And this shows how stocks have been outperforming the 10-year yield, although we're coming down to the 50-day moving average. And then the long term look at the 30-year bond. We're still pretty much going sideways right now. And then we look at a long-term ratio of stocks to commodities, kind of flat here. We're trying to establish more of an upward move as bonds are trying to outperform commodities longer term. Now we look at the sectors. Materials, which fell under their 200-day moving average, came up to their 50, and now we're back under their 200-day moving average again, and still underperforming the S&P, even though they've been bouncing up lately. And communication, this is a big growth area. We're a little bit concerned here. We're dropping further under the 50-day moving average, and we're underperforming. We fell under the 50 and 200-day moving average with the ratio of communication to the S&P, even though it's still in an uptrend. We want this to be going up when the market's more positive, not going down the way it is right now. Energy, which is above its 50-day moving average, and it's above its 50-day moving average here when we look at the ratio with the S&P, but it's going to have to do this much more than what it's already done to change the longer term trend of what we're seeing here. And the financials, which are under their 50-day moving average and are still underperforming the S&P. I stopped showing this chart in the daily video because it's just we're just seeing this continue to go down, 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 down. We haven't really heard any news. There hasn't been any real catastrophe in the financial sector. We're wondering, okay, what's the market picking up here that we don't know about yet? The market is there's a reason why this is happening, and we're just kind of waiting to see if something ends up developing. And then industrials, which are doing okay, they're more geared toward what the economy is doing, a little bit under their 50-day moving average, but when we compare it to the S&P, underperforming. Tech sector, the big growth area, pulling back, still above its 50-day moving average and bouncing off its 50-day moving average with the tech to S&P ratio. Again, is this enough? Have we tested things enough? And now we're going to start to go up from here. Now, if this ratio continues to go down, then the answer is probably no. There's still more downside left. And staples, which are in a downtrend, but they've been bouncing back up recently and really underperforming. But you can see lately how they've been coming back up. But they're going to have to just continue to go up really strong to see an overall change in the climate of the market. Real estate, underneath its 200-day moving average, bouncing up a little bit, but still underperforming the S&P longer term. Utilities coming off of their highs, also testing their 50-day moving average, and they are in a downtrend, and they're at the 50-day moving average with the ratio, and just kind of chopping around right now. And here's another look, and I haven't been showing this chart in the daily video. The S&P to utilities ratio, not showing a lot of consistent conviction. In healthcare, this has been the strong area, actually enough to generate a golden cross. And we'll see. Is this just folks trying to buy some bargains because they're good value? Or is this going to generate a general shift in the overall market that might be turning more defensive? because it still has a ways to go. Now we're coming back up to the 200-day moving average with this ratio, but we're going to have to stay up here and keep going up for this to turn into an uptrend. And then discretionary falling down below its 50-day moving average and underperforming the S&P. But you can see when you look at all of this together, we're just kind of in a sideways range, and we have been going back to March. Then intermarket, looking here at gold is still the best performing asset, followed by stocks, then commodities, then the price of bonds, where we have oil and the dollar are negative year to date. Correlations, fairly neutral, but trying to come back down here when we look at stocks to the 10-year yield. The S&P to oil, a little bit above the neutral range right now, slight tendency to go in the same direction. And the S&P to the dollar, neutral right now, even though this has been shifting a bit lately. And then the tech sector, the 10-year yield, still neutral, but slight tendency to be going down, which means they might turn and go in opposite directions. And coming back into the neutral area when we look at the S&P to the 2-year yield. Then some long-term charts here. Still looking good longer term. NYSE composite monthly chart. We're flat with price action, but we're still above an advancing moving average. But the copy curve, which is pretty touchy, and it's been going down ever since the beginning of 2025. Seeing a little bit of a pullback here with the NYSE record high percent index. This is also a monthly chart. And rolling over, but still going up here when we look at the S&P. In longer term, monthly chart still above the moving average. And then another US to global stock measurement here, coming kind of getting close here to the moving average and also showing a bit of a downtrend that started earlier in 2025. And then we look at the S&P again, and then a stock to commodity ratio longer term, trying to turn up. It hasn't quite crossed above the moving average. Then here are the positive things. There's one change, and there was one thing taken off of this list, and that was Bitcoin. So you might want to just pause. I'm not going to read through all these things, but just, oh, I didn't know that was positive. Just kind of look at this and see what's useful to you. And then we go over to the negative side, and we have a new addition, which is Bitcoin, where the dollar and the yen to the dollar and Bitcoin itself. So we'll be keeping an eye on that. Mostly, it's what I watch over the weekend because the markets are closed, and it's kind of a proxy for the NASDAQ 100. So if it's seeing a lot of pressure, that might not bode well for the NASDAQ 100 come Monday. Thank you. Have a really good weekend, and I will talk to you in the next video.